Hi, Andrew. Thanks for joining me today.
You're very welcome.
Well, we're here to discuss a common issue we see in many client portfolios, a concentrated position, meaning someone has a very large position in a single investment. Andrew, can you explain what it means to have a concentrated position and why we see this so often?
Absolutely. That's a great question, Susie. First, let's start by defining a concentrated position. At Fidelity, we believe any single equity position representing 5% or more of a client's total stock exposure is considered a concentrated position. Often this happens without an investor even planning for it. Sometimes it might have happened because an employer's stock grant or they received an inheritance. Or it simply could be from good old-fashioned stock picking. You bought a stock a long time ago, it's appreciated a great deal in value, or maybe over time it split a few times, which added the number of shares that you own. The way these concentrated positions often occur can make it hard to let them go. Sometimes people may be reluctant to let the stock go because it's done well for them. And the most common reason, Susie, people hold on to concentrated positions is they're concerned with the tax bill that would come with the sale of the stock. So they're letting their taxes make an investment decision for them.
All right, well, now we know what a concentrated position is and why so many investors have one. Why is it risky to hold a concentrated position in a portfolio?
Concentrated positions are inherently risky. That's why we believe in diversification, which is the act of spreading out that risk across many different investments. So in the event a single company has an off quarter or year, no one position will drag your overall portfolio down. Investors need to understand that risk trumps taxes here. We would much rather see a client pay 15% in long-term capital gains tax versus 50% in market loss. Investors often assume that their only option to deal with this concentration is to die with the gain. They hope to pass these shares to beneficiaries who will get a step up in basis, potentially reducing their capital gains. But the strategy has risk that investors may not recognize. You don't know the year in which you will die, and more importantly, you don't know what the tax code will be in the year in which you pass. The tax code is ever changing. Today, there is a step up for beneficiaries, but someone might plan to leverage the strategy only to pass away in a year that the step up policy has lapsed or been eliminated.
All right, well, it's certainly hard to predict when you might pass, and clearly taxes are a major concern when it comes to reducing a concentrated position. Are there ways to do this more tax efficiently?
Yes, in fact, there are many options to reduce concentrated positions that we discuss with clients. It's important to note, too, that these aren't an either or. It is not uncommon for an investor to take advantage of multiple strategies at once. The first and the most obvious one is simply realizing some or all the gains by selling the position entirely or bringing it down to that 5% level we discussed earlier. For clients considering this strategy, we suggest identifying how much capital gains they are willing to absorb or realize in any given year. They might take a multi-year approach to this strategy by spreading that tax liability out over multiple tax years. A second strategy often paired with realizing gains is harvesting losses in other positions in their portfolio and using those to offset any capital gains. If you sell a position for less than you paid for it, you're able to use those losses dollar for dollar as a tax credit to offset your gains. Any remaining losses can be applied up to $3,000 a year to reduce ordinary income. If there are still losses, Susie, left after offsetting the gain and your income, you can carry those forward for use in future years. A third strategy that would likely require a multi-year approach is to dilute the concentration by purchasing new diversified positions over time.
All right, thank you, Andrew. Now, here at Fidelity, we often talk about the potential tax benefits of gifting to charity. Can this strategy help to manage taxes on concentrated positions?
Absolutely. If you give shares of stock to an individual while you're still living, the recipient will pay taxes if they sell. However, if you gift appreciated positions to a charity during your life, which we call gifting the gain, and typically those gifts are fully deductible to you in the year of the gift, up to 30% of your adjusted gross income, charities do not have to pay taxes on those donations either. There are two options to gift stock to charity. You can gift directly, or you can open up what's called a donor advised fund, or DAF for short. A donor advised fund is a vehicle that allows you to get an immediate tax deduction in the year in which you fund the donor advised fund. Your gift then has the ability to grow within that vehicle tax-free, and at a future date of your choosing, you're able to grant those dollars to a charity you are passionate about. And in some cases, clients will front load their giving accounts in years where they need the tax deduction the most. For example, a year in which you realize gains from your concentrated position. One really important thing to take away from this strategy is the most common asset we see people give to charity is cash. And that isn't always the best asset to give. We encourage people to consider giving their appreciated securities, which may have significant gains, and these could be those concentrated positions.
Andrew, these are a lot of terrific ideas. Now, are there any other strategies some of our clients may want to consider?
Yes, in fact, there are a few other strategies I believe are worth mentioning. The easiest way to manage a concentrated position is to not develop one in the first place. This may require consistent monitoring and having a plan to diversify ahead of time. For example, if you receive company shares, consider selling before they develop an embedded gain. Another strategy that is more advanced is an exchange fund. This is a pooled investment that allows you to swap your concentrated stock for interest in a diversified basket of stocks, immediately diversifying your holding without triggering an immediate capital gain. This strategy may not be suitable for everyone, as there are net worth qualifications that investors have to meet and limited liquidity within these funds. There are also hedging strategies such as buying equity collars and protective puts that are available for certain sophisticated investors. These strategies can help reduce risk and protect against volatility while maintaining ownership of the concentrated position. Each of these strategies come with their own risk and aren't appropriate for everyone. There are many different strategies investors can consider, and there's no one-size-fits-all approach to addressing concentrated positions. In practice, some investors may choose to use one or a combination of these strategies. Finally, given each investor's situation is unique, we always encourage people to consult a tax advisor before employing any of these strategies we discussed today.
Well, Andrew, this was fantastic information. Thank you so much.
It was my pleasure.
If you have questions about managing concentrated positions, reach out to your Fidelity representative. If you don't have a Fidelity representative, visit fidelity.com/find-an-advisor. And for more timely news and thinking from Fidelity's top thought leaders, subscribe to Insights from Fidelity Wealth Management. I'm Susie Allen. Join me again soon.